Good day, fellow investors. Berkshire filed its 13F, which is the document where each fund that manages more than 100 million has to disclose their long positions, not the short positions, not the derivatives, because if that would be the case, then we would know what Ray Dalio is doing, but we know what Warren Buffett is doing as his 13F is out. And it looks like this, which is a complete mess and a very complicated, very active quarter for Buffett, because 15 buys and 7 sells is a lot for Warren. Let's first discuss some on the list and then dig deeper into those here for more insight, and then at the end I'll give you my conclusion about what's going on with Berkshire, or at least the feeling I have. I think it's getting messier. Buffett is not really as sharp as he was because simply some of this doesn't really make as much sense as what Buffett did in the past used to make sense. Let's start. So apart from the Apple small increase we'll see in the next quarter, if he bought more at 155, he has a big stake now in Hewlett-Packard, so 3.8 billion or more than 10% of the company. We discussed that in a video before Buffett announced his purchase, so I was pretty okay there. It is value, cash flows. The stock has jumped even more since everyone knows that Buffett is owning it, but that is now the situation, and the market cap is 41 billion. The price earnings ratio is extremely low. There is a dividend yield and there are buybacks. There is likely a good market position, so everything that fits a value investment and therefore also fits Warren Buffett and Berkshire. Of course, 4 billion won't move the needle, but given the agglomeration, he is collecting even smaller positions now, running away from inflation likely. Next change, Kroger, itsy bitsy slightly down, 5% down, which might signal that it is time to trim the position. I made a few videos on Kroger recently explaining groceries, how those are good. Those are not 10x's, but 8% should be okay. And there was also a valuation here explaining how Kroger is likely a good buy for the long term. Also, I made this video almost 5 years ago, so when I just started with YouTube. So if you want to watch something to get a good laugh and also to motivate you that if I, with my English from 5 years ago, managed to create a good YouTube channel, then you can do anything you want in life. That's the motivation message for this video, and also time to have a good laugh. I'll put all the links to the videos I mentioned in the description below, and you can have a little bit of fun. So this was made on the 25th of June 2017, and I said that Kroger will beat the S&P 500. So from the 27th of June, 25th of June 2017, Kroger doubled. So that's better than the S&P 500, as it is 111% up plus the dividend. So I was pretty correct on that, explaining the market's irrationality even with my bad English. Enjoy the video for some fun. Now Kroger is much better on cash flows, but I think this should revert as the COVID situation slows down a little bit. People spend a little bit less there, but still, if you go to my comparative table, free download link in the description below, if you scroll down as it was a while ago, so here was my valuation of Kroger, and here I said when the market cap was much lower that the cash flows are good, they're going to use it for buybacks. Slow growth rates ahead as COVID was not an issue yet, but here we look at the valuation, and now maybe the cash flows are 2 billion, so stabilizing 2.5 billion, but Kroger is increasing the dividend per share as they're lowering the number of shares due to buyback, so really rewarding shareholders, and they have a very stable and good position in the market, so nothing wrong with Kroger. But given the price increase, it might be that Buffett said, okay, let's start trimming a little bit because this can happen next. So Buffett also likes to trim, as we are seeing here. And the same we are seeing with Store Capital, sold 40% of his position, so one that he bought at $27 something. So he might have enjoyed the 5% dividend over this period, but now, with increasing interest rates, with pressure on the economy, with pressure on spending, with pressure on tenants, with higher debt costs, he might be thinking, okay, it's time to trim these REITs a little bit. And that's also, again, something that I get confused by. I don't understand the trimming action. It's either good or bad. So either you sell it all or you hold it all. What does it mean for Buffett to sell 400 million of something? That's again something that I don't understand and doesn't really go in line with Buffett's usual sharpness. Then we have Wells Fargo being selling over the last few years, now totally exited, so likely he got fed up with the management, with what's going on, so he said, okay, the stock is up, let's sell everything and then get out of it and focus on better. Then other two sells were pharma companies. I made a few videos on those a while ago and Buffett was buying, so we analyzed that. Then he might have enjoyed the dividend here. As the stock price went higher, he might have said, okay, too risky, time to sell, price earnings ratio is high, competition, the outlook, technology, taxes, governments, Medicare, who knows what. So he said, better to sell, trim my positions. AbbVie also, he did good here, so time to trim. Maybe he is thinking about that he can find better businesses, and we will never likely know why he sold. Then another mention here is Activision, huge increase in the position, and we mentioned in the video discussing the conference how it is a merger arbitrage. I said there how there is a big difference between owning Activision as merger arbitrage and Twitter, so always keep in mind the risk and reward. If it fails, then you own the company as an owner, which is likely good for Buffett. And if it goes through at 95, what Microsoft is willing to pay, and Microsoft has the cash to pay for it all, then you get 20% pretty sure, which is something really not bad in this market. That's merger arbitrage investing, so you have to see how that fits your portfolio. Then we have some other plays, Floor & Decor, again 400 million, Ellie Financial, Markel. So I don't know whether this is from Ted or Todd, whether this is a stake somewhere in some pension fund from some company they own or something, some acquisition they made, something there. We don't know, we will never know as this is not really disclosed, but we see here also Markel, which is considered the baby Berkshire, also discussed in this video, again in the link in the description below. I think Berkshire is better, so it's very interesting how this got there, but we'll see over time whether they'll take it over or not. Then another new stake, McKesson. Again, now I don't understand this now. So free stocks to buy December 2018, McKesson part 1, December 2018, we were here, so two stocks to buy, McKesson 100, now we are at 300, that's a triple, and now Warren Buffett opens a stake in it, now, here, in the first quarter, here. I don't understand why not here. Of course, some legal issues have been solved, etc. But still, it is Warren Buffett, it is the business. Why not be more sharp? And there were plenty of opportunities to buy things cheaper when he had the 100 billion. Why spending now? Again, questioning whether Buffett is getting slower. Of course, if we look at McKesson, the cash flows have been there constantly, so not a big change. Great company, stable company, okay, more sales due to we know what has been going on, but now he started increasing. They've been doing their buybacks already back then, so nothing wrong. I don't know whether there was so much mitigation opium risks there because they have settled it all, so it all evaporated there. Then we have Celanese, or however it is pronounced. So a company making some form of acid, and they're doing really good now. The stock is up, so the price earnings ratio is really low. And if we look at the earnings per share, have been going really up. The company has been really strong in buybacks, and the free cash flows have been up. So 1.5 billion free cash flows, 2 billion net income compared to the market cap. That's a price earnings ratio. Free price to free cash flows also single digit, so a value investment. And we have to see the cycle of the acid sales over the long term at whether this is now a buy or not. But the numbers look really good, growing here. Don't know if they made an acquisition or just prices exploded here, which lead to higher cash flows. Then oil. Big buys there, huge buys, a lot of money spent. And what I don't really understand is, of course, he started buying Chevron cheaper here, but he could have been more prescient with the amount he has been buying and bought more. When I made a video about oil stocks, how those were cheap, unlikely to get lower, low risk, good long-term reward, but he preferred buying here, okay, not as sharp as we would have expected from Buffett. Also selling the Occidental shares he got as the preferred dividend immediately instead of holding for the long term, even if he knew he could save Occidental by himself if needed. So again, a big surprise, Verizon, he sold off the complete stake. So Verizon, the telecom, dividend, okay, there is high debt, but the price earnings ratio is low and the dividend yield is really high. After the last earnings, it has dropped a bit, now rebounded a bit, and the news is that the costs are increasing, the competition is there, and they can't transfer the price increases to customers, which makes it not such a good situation. And then Warren Buffett also dumped his stake. Maybe he considers some other options better, but it is really surprising as, of course, there are always these telecoms fighting. Sometimes one is stronger, the other is stronger, but Verizon has a stable position. You are using the internet likely also now. You're a customer if you're watching from the States. So that is something that, again, I don't understand. I thought that he liked the position, and if there was ever trouble with the debt, he could help the company like he did with other banks in the past, but likely he prefers other option, and he sold a pretty big chunk of it as it was a pretty significant part of the portfolio. I also made a few videos analyzing Verizon, looking at the long-term growth. I don't think it changed that much. It was a dividend stock. Buffett owned it, now he doesn't own it anymore, but it is a stable telecom, so he likely knows better or has better. They have made huge investments, so that should lead to some cash flows long term. 20 billion in profits, to lower debt, to increase likely over time slightly the dividend as they did in the past at 5, 6, 7%, maybe 10% on your cost over the next 5 to 10 years. So we'll see how it evolves. Next company, Restoration Hardware, added 19% to 0.7 billion. I made a video April 2020 how Restoration Hardware is a stock that must go up because they were issuing preferred shares and then doing buybacks, huge buybacks with that money. I also made an update video and discussing buybacks more in detail, how it backfired for Restoration Hardware, and now I see that Berkshire increased the position. Now I'm thinking maybe they are just playing around with the preferred shares, finding Todd and Ted, maybe finding some, or whatever their name is, finding some merger arbitrage there plays, low risk, good reward, where they park their money, and therefore you see these fluctuations in restoration hardware. Because I've made the video here how the stock must go up on financial engineering, on buybacks, and then of course it exploded, and now of course financial engineering can only last as long as it lasts, and now the stock is down. And it is a company that made huge buybacks, and you can see here the number of shares going down, 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 and then as you are issuing preferred shares that will be converted later, now you see the number of stocks going up, and therefore there is no sense in making all these buybacks if you're going to issue stocks later. So that's something I don't understand, but maybe this is the game Buffett is playing, just buying preferred shares. Also, free cash flows, okay, 400 million as the craze of refurbishing houses, etc. I think this will stabilize likely, let's say 300 million. And if I compare that to the market cap, okay, price earnings ratio long term 20, growth, yes, okay, but it doesn't seem like a Buffett value stock, but more likely a growth stock, which is again not Berkshire. So I might assume they play with preferreds and turn them around, but we'll likely never know. Then again, Formula One Group, again a small position, but okay, what does Berkshire do with this? So also now that when the stock is higher, much higher than it was, now they're adding, why not buying the whole Formula One circus here or here? Now they're adding a small stake and 400 million of free cash flows, which was the best year here. Actually, net income always losing money, but now they add a small stake there. I don't know how that gets there, so that's something we'll never know. Again, Paramount Global, new stake 2.6 billion. If I look at what's going on, okay, net income 4 billion, global class not going anywhere, 20 billion, so value likely there, very low price earnings ratio, dividend yield, but maybe they are assuming that the company will be sold, which is the rumor. So maybe just another merger arbitrage where they know more than we do, or they see value there and assume that someone will go after that value. In the crazy environment that is there now with streamers for content spending a lot of money, as we discussed in the recent short, so okay, whether it is profitable, it will likely be for Buffett, but whether the whole sector will be profitable in the long term, that's again a big question. And I really think Buffett is doing his best, but most of those are not really value investing. He's not waiting for the elephant. He did a lot of buys over the last quarter. The price paid is much higher than it was. So if you're looking at values, owning businesses, why didn't you buy before? He's doing a lot of sells, which is not in line with the hold forever of trimming positions or something like that. Buying Apple on just one day, that's not really Buffett. I also don't get the diversification. Buffett said always invest in your top idea, not in your top 10th idea, and now we see 15 ideas. And again, I don't get some of the positions absolutely, but this is Buffett. He's 90 years old, the best investors that ever lived, so nothing to say against them. We'll see how it works out. Berkshire is a business that even someone with dementia can run. The quality of it allows it, as Buffett said in the conference call. So let's hope that it is all good for Buffett. I personally don't find much great ideas here now. I find the risk and reward balanced out, so not really great value investments, except maybe the Activision merger for part of a portfolio. The rest is all a little bit hanging out in the air, which is not again the real Buffett great opportunities, low buys and high sells. So a little bit confused, I must say. Let me know in the comments what you think about it, and I'll see you in the next video.